think you actually touched on a very important point, which is commercializable idea. So we see a lot of companies, and they usually come to us with, VCs told us we can get X. And the question is, well, can VCs really commercialize you? And I think, the value proposition is always a little bit of a trade-off between do you go with somebody who just gives you the most money to spend today and kind of deploy, as you see fit, in the short term, or do you go with somebody who can, turn on kind of their channels to help you market your platform, but it might not be the numbers that you want? And there is actually a pretty simple answer to, how some of the most successful companies I've seen have done it. They tend to partner with both. And I don't know how many of you guys know this, but banks are actually not allowed to be lead investors in most cases, just because of bank regulatory kind of concerns. So you can't really go and buy 50% of the company unless you want the company to be regulated, like you're being regulated, which I think the entire point of startups is not to deal with that. So when you're talking to investors, the biggest push should actually be, how do I partner with somebody who can help me commercialize whatever I'm building, but also how do I get enough VC money? And it can be at entirely different valuations. I think a lot of people don't realize, but there are strategic rounds and there are VC rounds, and they can coexist at the same time or they can be separate. But there is, the industry is relatively sophisticated at this stage around the process, so there are actually multiple ways of, solving both problems at the same time.
Yeah, and having a diverse, investor group is super helpful, and advisory board, right, to bounce ideas off of. So that's really that.
Awesome. That's actually a great segue into just fundraising in general, and just sort of like what do you guys like? What are you seeing in the industry in terms of like trends for fundraising, both general companies as well as fintech? I think something the audience may or may not know is that prior to these recent like fallen unicorns or whatever we want to call them, at least the fintech area has really been exploding in terms of investment. I believe VC investment into fintech roughly doubled in 2018 from 2017, and it was already moving up fast. So both in fintech and also in broader industries, like what do you think are going to be the trends moving forward over the next 1 to 2 years, and where do you see some of the most compelling opportunities?
I mean, we're on a 11-year bull run. Private valuations are through the roof. I think that there's probably a correction at some point. Who knows when. Oddly enough, like usually when there's a correction, it's because skepticism is gone, but there has been a healthy degree of skepticism in the market. But there's a lot of money out there and a lot of different philosophies around investing. So I think that, while you might want to just like pounce on a term sheet if you're trying to raise a company, right, I think you need to be thoughtful and who you're taking money from and what their goal is too, who their LPs can be. And to your point, I mean, having an investor that then also wants to commercialize and scale your product and work with you is super important.
Yeah, kind of pretty much agree with all your points. I think even within the VC community, there are quite a few people who have never really seen the bear market. So the 20-30% returns are actually treated as something entirely normal. I don't necessarily think though correction is going to be a bad thing. I think the good companies, good ideas always get funded. It doesn't, there are good companies that were funded in 2009. At the time, I was personally on kind of hedge fund side, and if you think you can raise money in that environment for a hedge fund, you can do anything. It's just about the idea and a little bit of product market fit, but there is always a way to do this. Now, in terms of what's actually going on, and I'm obviously not allowed to mention any, other financial institution's name, but there are obviously a couple of players there with a lot of liquidity that they created, that they're now having a lot of issues financing themselves. And I think that led to some outside valuations. Thankfully, a lot of that money was actually also spread globally, so it's not just US that's going to get hit, and it's not very concentrated in the US tech sector. But that's probably the one thing that we'll see in the near future. You'll have some sort of washout from just companies that are very overvalued, and you'll probably see some down rounds, which again is not really unhealthy in the longer term. It's for startups themselves, it might be a little bit of concern, but again, good ideas always get funded. And then the other very interesting kind of thing that I'm actually seeing, this is sitting at a big financial institution, but financial banks used to deal quite a bit with kind of big tech on the kind of retail side, and consumer finance in general has been, kind of growing together with tech. Big tech is obviously trying to enter the space. They have made a lot of progress. They are very good at building technology, sometimes better than us. What you haven't really seen is capital markets technology kind of merging with big tech, and I think the next kind of big development is probably going to be, big tech partnering up with banks and experts in kind of capital markets field to actually build solutions together, because we understand, on one side we have somebody who's amazing at building technology, on the other side we have experts who know what the problem is and who know how to get to a solution, they just don't know how to build it exactly. So I think that's going to be the next kind of big theme driving at least my kind of part of, investment and incubation process as well.
Yeah, so I'll add a couple things. So to your point, yeah, like fintech startups are booming, right? We're not really seeing in fintech what we're seeing in other industries. Companies like Stripe have huge valuations, are doing very well. I think we're going to see a trend or continued push from a lot of like the incumbent players to develop strategic partnerships with fintech startups and invest in them also for strategic reasons. I think there are a number of recent examples. MasterCard and Visa, for example, invested in Plaid. I think that was announced a few weeks or a few months ago. There are others, and I think that will keep happening. Those larger incumbent companies, both on the banking side and on the tech side, I think will realize that's like an important part of their strategy. So I think that's one thing that we'll see. And as far as the types of startups that I think will become more and more interesting, I think startups are operating the reg tech space, working around compliance issues, KYC, AML. The startups that are maybe not doing like the more sexy or attractive work are going to be more and more valuable because again, banks need them. Banks are sitting on top of very old legacy infrastructure, and we're seeing a lot of startups coming up with interesting solutions to address pain points that banks have. Startups don't want to be, or don't want to be, and in some cases can't deal with regulators in the way that banks can, but they can develop sort of the technology layer on top of that to make banks a lot more efficient. And I think that's going to be something that we'll see in the next few years. More and more of those startups getting more capital.
And I totally agree with you. To add to that point a little bit too, I think fintech, right? I don't know how everybody thinks that exactly. Most people think about like money transfer or something, right? But there's so much more. I mean, there's settlements, back office settlements, all these processes that could be more efficient with technology. And self-promotion, new IDs, focused on authentication and security, cybersecurity, which is becoming a more and more important aspect of fintech day by day. I don't know if you guys follow all the breaches that happen continuously, but it's hitting banks, it's hitting startups, right? Everyone, and so I think there's as everyone was kind of saying, a lot of these kind of peripheral services that need to be built out, right, to even help support fintech, more efficient money transfer services, yada yada yada, exist, and particularly digitizing assets, which is something I would love to see come mainstream.
Yeah. I mean, so obviously my personal interest in the regulatory tech or the reg tech side of things, and that this is one of the big problems that's yet to be solved. For particularly, let's look at blockchain. There's a big reason why blockchain hasn't been widely adopted by corporations and enterprises. There's a few big flaws in the whole system. When you have permissionless blockchains, they're subject to chain poisoning. They're not compliant with privacy regulations. There's all these issues. So there's things like GDPR in the EU with the right to be forgotten. So once you upload content to a blockchain, it's there forever. So what if you upload terrorist content or inappropriate content or somebody's personal information? So these things are completely non-compliant. So there's a lot of big issues that need to be solved where regulatory, the reg tech piece is kind of one of the missing pieces of the puzzle. People have figured out the distributed database, the world computer with Ethereum. A lot of these things have been figured out, but to get them to the next level, there's applications that need to be resolved. And I think whether it's KYC or privacy or compliant licensing, whatever it may be, these are big areas of growth going forward for the whole fintech space.
Yeah, I mean, I think that identity is like one of the most crucial things that needs to be solved, right? Like, how does one represent themselves online? And right now, it's like maybe your email implicitly, and that's just protected with a password, right? And in crypto, you have a public key, and if you lose your tokens and you're storing them on cold storage, then that's gone. So that doesn't really support equity. So you need transactions associated with an identity, and that has to be a secured identity that a user can prove that they are themselves, and also have that representation of themselves verified. And that is like I would say at the crux of so many of the efficiencies that we're trying to solve in the fintech space.
Yeah, like even just going into like, I don't know what's happening right now with like, challenger digital banks. Right? I mean, those guys need to onboard millions of customers in like minutes at a fraction of the cost that a bank would normally pay. And banks,
they're all branches.
Right, exactly. And banks will have to do that as well, because the the expectation will become that. So yeah, completely agree. I think identity is like a major thing right now, and a lot of companies working around it are going to see more funding and more stuff happen.
I'll just add to this. So we actually just had Digital Identity Conference last week.
Which one?
It was cities.
Okay.
City
There's so many
organized.
of these.
City organized. No, we have made a couple of investments, not out of my group specifically, but we've made a couple of investments in the space. And when I'm looking, when I'm including a project, for example, there are a couple of them right now that I'm working on. Let's say you're trying to build a trading platform or a settlement platform. The first thing that you need to do is actually be able to identify that the client is the client that you KYC, maybe somewhere else, maybe manually, but the process always comes back to how do I know who I'm transacting with? And it raises all types of questions, and there's some really, really creative, interesting solutions. Some of the more interesting stuff that I actually seen, especially coming out of that conference, was it's not only digital IDs for individuals. There is a lot around digital ID and KYC for institutions. So how to represent a person with an institution. And the most kind of surprising part was actually there are a few companies that are trying to create digital IDs for machinery or cars or other kind of non-human but still represents part of your either workflow or business or supply chain. So everything is getting ID'd right now, literally. So it's quite an interesting space to be in.
It is, and obviously I'm biased because that's the space that we're in. But it also comes down to authentication at the base layer, right? Because if you can authenticate yourself as me and then take over my digital representation of myself, then how can you ever trust that actual digital identity, right? So I won't rant about that right now.
No, but so the trust part here, I think that's actually the biggest key point, because why are you trying to ID anyone? You're trying to ID them so you can actually trust them, whether it is to do a transaction with them or, more interestingly, probably be around sharing your own information with them.
Right.
So ability to identify somebody and giving you access to kind of how you share your own information is probably going to be the most interesting solution. And it's going to apply to consumers, it's going to apply to capital markets, it's going to apply, I think, kind of across the board.
Everywhere. I mean, you want to verify that information you're sharing is going to the intended recipient, right?
And
then
you choose to share it.
And you choose to share it, right? I mean, self-sovereign identity, user-owned, data is a huge thing that that we're focusing on. But with digital assets as well, those need to be associated with an identity, right? So that's you need accountability in the system at the end of the day. And I think that with blockchain, that was always kind of kind of grassroots stuff, libertarian, didn't want to work with banks, and banks kind of were like, Jamie Dimon 2 years ago was like Bitcoin's a fraud, and I think that what will really help a lot of this stuff come to life is companies and banks and large institutions with startups kind of coming together and bridging that gap.
There are a lot of efforts, especially in the DLT space. It's one of the spaces that I'm directly responsible for. there are a lot of efforts, and a lot of them actually are coming from buy side and bigger clients who want to digitalize assets, physical assets, in any type of transactions to make it easier for them, but also make the transactions represented in a way that they can deal with it in the longer term. That there is a lot of effort going into that right now. It's just a question of you need the first proper proof of concept that's successful on large scale to really make it work.
Do you guys work with digital asset or table?
Can't respond.
Okay.
Great. So that actually tied in with the last questions, which were around the regulatory environment and also just where you see the fintech industry more broadly heading. And just as an anecdote, like I was actually meeting with the venture group at a large top 10 issuer last week, and over half of their early stage investments in the last 12 months were RegTech. So you guys are definitely very much right in that regard. But just bring it back real quick to sort of the general industry, and we have to keep it a little quick because we're a little tight on time, but like where do you see the broader fintech market going over the next few years?
Well, I think that as far as the broader fintech market, there's we're at the very early stages of the growth cycle. So I think there's going to be a lot of innovation, a lot of growth. This is just such a large problem to figure out that I'm not really worried about where we are right now in the marketplace. There's just a tremendous amount of runway ahead of us in all these different segments. So this is a multi-year opportunity.
Yeah.
Regulation is always tough on us, on everyone. I'm not gonna lie. It's usually not a positive, but there is kind of the flip side to it, which almost surprised me recently. So a lot of regulation in the capital market space right now is going towards a more trade transparency. You know what you're doing, there is the best execution. There are a lot of kind of rules that came out post-crisis, really in like 2014, 2015. And a lot of those problems that regulators are asking us and all the financial institutions to solve can actually be solved with technology much better, which leads to much faster adoption. So if electronification of the markets was kind of a wish list thing before, right now it's becoming just must-have, otherwise there is no way to keep track of everything that was quoted, traded, et cetera, et cetera. So it's actually helping to drive adoption, despite being, it is what it is.
Yeah, I mean, I think there's a lot to be done. And, if we go back a few years, the discussion was maybe around who's going to win, fintech startups or banks. And around regulation, the discussion sometimes is regulation good or bad? I don't think that's really the right way to think about it. I think banks and fintech startups will collaborate, and that's really the path forward. And regulation is really just something that's out there that both startups and banks have to deal with, and it's more productive to think about it as an opportunity. And many startups, I imagine yours are capitalizing on that. Right. Banks need to comply with regulation, and certain startups are making that easier. So I think that's sort of how I see the industry moving forward, not in a way where those players are competing, but in a way where those players are working more effectively together. Even in the regulatory side, you're seeing the FDIC recently launch like a lab initiative to make bank fintech partnerships easier to take place, and that's what I sort of see as a trend over the next few years.
Yeah, I think a lot of sandboxes, whether that's coming from large institutions, banks, or if anyone's familiar with the Chamber of Digital Commerce, like policy groups, there's a lot of people pushing for kind of lax regulation. Let's let things play out a little bit and see where efficiencies can be solved before we just kind of crack down. Cryptocurrency speculating is just a whole other world. But a couple of years ago, Santander published a paper that said with certain like distributed ledger technologies, back office settlements could go from equity settling in 3 days to minutes post trade. Right? They thought they could save, I think, $20 billion annually a year globally by streamlining back office. I mean, when I was working on a trading desk, just I guess 5 years ago, there were still fax machines in our back office, like settling equity trades, right?
There's still products that take 15+ days to settle, especially in the credit market, so
Yeah.
equities is actually the easiest one.
And then the actual settlement is always right, you know, I mean, yeah, all the banks hated blockchain, and then, you know, about 2 years later, Northern Trust is launching like their own chain and stuff, so. I think we're starting to see the convergence of a lot of, you know, a lot of players in the space, and it's gonna continue to happen, and we're just gonna see time kind of, you know, get denser, and things happen faster, and people, you know, start to, I think, turn on these efficiencies, or inefficiencies.
Awesome. Well, thank you all so much. You know, like that concludes at least the panel portion. I think we do have time for maybe 1 or 2 questions from the audience.
How often are you talking about these startups that address problems in banks with legacy systems, but how often are there implementation problems because there's so many different systems to work with integrating data at the banks? So let's say a startup comes with an idea, but then it can't be implemented.
Sounds like that's a question for me. I mean, it happens all the time, right? That's the entire point of having a group that's not just, you know, investing in a company and then forgetting about, you know, what happened to the company until you see some sort of return. It's a point of sitting in the business and actually making sure that the implementation happens. There are always connectivity problems, that's a given. I think there has been a lot of progress made towards, you know, there is a more systematic way of addressing it. The technology on the bank side is closer to the technology, you know, at kind of fintechs. So, and there are also quite a few platforms actually that, you know, we either invested in or we looked at who specifically work on connectivity. So there is no way that any fintech company is going to come up with a solution just naturally plugs into all the legacy infrastructure across everyone. It just doesn't exist. But there is a lot of effort being made right now to make the connectivity relatively seamless, using either third parties or internal teams who are specialized in that.
There's also a lot of failed proofs of concept, right?
I just wonder what the percentage is.
So I'll add a little bit. So I think the percentage is very high right now, right? And that's sort of like what we were talking about as far as like the trend and the continued evolution of you know, the fintech space. I think what you're seeing more and more is banks that are developing, you know, an API layer to, you know, be able to connect with fintechs more effectively and more efficiently. And there are even fintech startups that are, you know, developing solutions around that. So if you look at a company like MX, just to mention an example, they just announced this solution called MX Enabled that allows banks to plug into fintech startups through the relationship that MX already has with the bank. So they already sort of have access to the bank's core data. So what they're doing is they're building a layer on top of that to allow startups to connect via, you know, a token to that data and be able to provide services to that bank. So as more and more of those solutions are developed, I think you will see, you know, a higher rate of success when, you know, those partnerships are of interest to both parties.
I think if you want to really quantify it, you just should look at how much skin of the game does any specific financial institution have to make that fintech successful. You know, when you're investing into something, it's very different than if you're onboarding them as a vendor. As a vendor, there is, you know, there is that much more space to, you know, let's see how they do and it's on them. If you're invested in them, you're going to make sure that they plug in because otherwise you're writing it down.
Yeah, as far as banks, I mean, the banks kind of remind me of the earth. At the center of the earth, you have, and for the many banks to stay, you have mainframes, which 40-year-old technology. If it doesn't happen on the mainframe, it doesn't matter where it happened in the stack, it didn't happen. So until it actually is processed on the mainframe, most data has not been processed by a bank. So you have mainframes, and on top of it, you built client-server applications in the 90s. Then on top of that, you start building cloud-layered applications. Now on top of that, you're starting to build decentralized blockchain-based applications. But when you can drill down, it's still the mainframes that are running a large portion of this data, shockingly enough. Now, completely new applications from the ground up, they don't require all that tech stack down to these legacy systems. But you'd be surprised how much legacy data and systems still are inherently driving a lot of the core infrastructure of the financial system.
That's totally undocumented and nobody knows
nobody
what's
knows.
sitting
The guy
there.
who owns
It's like,
it,
don't touch that box
ago.
over there.
Yeah. I think the average firm is looking to get into this today, if they don't have a broker dealer, is looking at 2-3 years in order to get to the, you know, the end solution. Starting with the broker dealer, you're probably still looking at 1 year to 2 years.
You can always buy a broker deal.
Well, anybody could buy a broker-dealer, but to be approved, you're gonna have
To register it.
Well, I can tell you exactly what you have to do. You have to specifically tell them what the line of business is. So if you go and say, I want to buy a broker-dealer, and I'm going to list tokenized CryptoKitties, they're going to stop you and say, okay, well, let's go through all of this, go through the whole plan. So your approval will be by the broker-dealer, will be predicated upon what you want to do with it. So that's one of the other big issues in that. You can't just buy a broker-dealer without saying what you're going to use it for. And if you try to buy it and use it for this, they'll shut you down anyway. So there's no way really around it. It's a difficult conundrum.
To run an open exchange.
Well, I wanted to ask a question, but it was actually kind of answered. But it's a twofold question. One, because you became an entrepreneur and you made the transition to decide to become a CEO or co-CEO of a company, what was actually when did you make the transposition where you was able to start your company and not be a phantom company? For an example, it was mentioned that you associated with banks. And in turn, for an example, you mentioned Amex, where they have their algorithms already going, and then you, I guess, piggyback off of what they do, and in turn, you have your app and people are able to use it. For an example, and I'm an electrical engineer, so I do all type of electrical work. But it was mentioned with Select. I think you mentioned Select. So we see Select and we know that corporation or that company has a division all of its own. Most people can't copy what they have because you have something that's raw. And when people see it and they have access to their, their venues, there's no one else doing what you do. And so we have a privilege to be able to go to some of their events. But my question is this, as an entrepreneur, when did you make the transposition where you said, okay, I started my corporation or your company, and you had this great idea, and then you jumped to the next level doing what you do, because you're not a phantom company now, right? You've grown and expanded, and now people see you and you're viable. You know what I'm saying?
I think so.
I think it's once you start, how do you? Because starting the company is actually really easy. The hard part is like building a company that lasts more than 6 months in a year and lasts 5 to 10 years to 20 years.
Yeah, I mean, you
So
want
I
to build a
think that's
sustainable
one of
company,
the-
right?
Yeah.
I would say that it kind of grabs a hold of you, right? And if you're sitting at, whatever it may be that you're doing before, and all you can think about is like what you're going to be doing next on this idea, right, or whatnot. You got to push that, right? I mean, do it for fun, curiosity project, and then if that, turns into something that's real, I play devil's advocate hardcore, against it, and then try to talk to people in the space, see who are the competitors, what am I up against, and then file a provisional patent application really, really quickly. You Hail Mary one of those in there, you have a year to amend it. And then, I think, there's a bit of risk, right? At the end of the day, you want to make sure that you're going to be able to eat, right, and have a house, or home. Whether or not you're connected to like the funding world or not, you have to kind of do a million things. So I think aligning your network and calling on people to help you and give you advice is a big step in setting that up. I mean, for me, it was 2 a.m. on a Sunday night, and I was down at the whiteboards in what we call the cave, my house in Seattle, and Nolan and I were like, fuck, we have to go to work tomorrow morning. I went in and quit the next day, so, I think it happens differently for different people.
I can speak to a little bit of it in Select's case, since that was referenced, and I loved the way he called what we do raw. I actually really like that because it's true. What we're doing is we're building direct relationships with all these businesses and basically setting up something that's completely proprietary, because our cardholders aren't getting a point or 3 points or whatever miscellaneous thing. They're getting 30% off. They're getting a round of drinks. They're getting both in a lot of cases. And we've managed to over time accumulate all the best brands. And it speaks to the point I was talking about earlier, is when we were first starting our company, we started to see a lot of the big financial companies reach out. Visa, MasterCard, most of the big banks, whatever. Everyone was sort of intrigued by what was going on, and what we thought, even Samsung and companies like that were reaching out. And it's okay, so everybody's interested in what we can do with payments and transactions because of our benefits, like, that's where we're gonna completely focus our energy. And that's basically what we've been doing for a while, and then finally, like, negotiated things to be able to introduce our own credit and debit cards, which was very challenging, because for a while, even though we had success and people were familiar with us, what banks wanted to do was white label. Pay us so their cardholders could access it, not give us a card. So
Read their MSAs very carefully.
Huh?
I said read their MSAs very carefully, right?
Yeah. But yeah, you know, that's the way we looked at it, is we just wanted to focus on an opportunity that we felt no one was really looking at, and where we could be the best.
All right. So let's give it one last hand for our